How are you? Welcome back. Welcome to Real Macroeconomics and Investing. Welcome to TradingView, my subscribers and YouTube, of course. All right. Um, this really irks me. It kind of bothers me because I saw a headline today that um, initial unemployment claims have never been lower. Population adjusted, it was 200 million in 1969. Now we're 333 million, and unemployment claims came in at 189, 83. I'm not sure what it is exactly. Um, uh, Now remember, these are weekly unemployment claims, and it is true that to hit 183 million, I'm sorry, thousand unemployment claims with 333 million people versus 200 million is a big task, right? It's really cool. But there's more to the story, and this is the part that irks me. And before I get to that point, I want to show you why the Fed was too late, is too late in tapering and raising interest rates and so forth. Now, if we look at certain key metrics of when the Fed typically in the past has raised rates, uh, we're going to see that they really missed the boat this time around. Okay. And as a result, we ended up with inflation. So, um, number one, if you go back in history, uh, these red dots is typically when the Fed starts to raise rates. Okay, the little arrows going up here. That's this one here and here and here. Now, this goes back to 1970. So I've only counted the last three, and they don't raise rates too often. In fact, they've been lowering rates more than they've been raising rates, and that should tell us something. Okay, it's a whole other topic I won't get into now. All right. So as you can see, we started to enter the area right in here where the Fed should have started to at least taper QE, if not raise interest rates. And we're not even tapering yet. We haven't even started. I mean, the private sector has started to uh, to taper to undo QE. It's a whole different video. Watch the previous video, and it kind of explains that. But we haven't even started to. Okay, so that's one point I want to make here. And by the way, the new line, it's not updated. It's somewhere down here. Okay, the unemployment claims. All right. So the next thing we want to look at is inflation. When does the Fed usually start to raise rates? When inflation gets to what level? And again, we get to the point where you see that three previous times we raised rates. And somewhere within this box is when they typically start to raise rates. Anywhere between 1/2% to 3%, somewhere in there. Typically, they start to raise rates. Okay, completely missed the boat on that one, and we're off to 6.2% inflation, and still we're not tapering or raising interest rates. Okay, so again, it's not a secret of when they should start to raise rates. Okay, they got a little cute, a little fancy. They missed the boat, and now we have uh, excessive inflation. Now remember, the dual mandate is price stability and maximum employment. We'll get to the employment part later. Okay, so they missed the boat. They didn't raise on this one. How about this one? The civilian unemployment rate. Usually they start to raise rates between 6.5% and 5%. Okay, now completely missed that boat. 4.2% unemployment rate. All right. Uh, all these metrics, they're basic, they're fundamental. you should have started to at least taper. I'm not even saying raise interest rate, at least taper. And they couldn't, and they didn't. Okay? All right. Now, I want to explain to you what does this all mean. Unemployment rate at 4% is in the context, okay, in the context of a falling labor force participation. All right. So this is to me more important. I don't care what the population is. I care about what percentage of the population is working. It could be a billion people, right? I still want it to be up here, somewhere around 67. It's not. It's down here at 61, right? Now remember, all these economic data, what they do is they measure the size of the economy, okay? So if the size of the economy or the labor force within that economy is smaller, then this is what they're going to measure. And they're going to say, look, it's 4.2%. Isn't that great? Well, I guess. I don't know. I don't think so. I would like to see 4%, 4.2% with this many people working. See, it takes on a whole new different meaning, right? So you got to understand the context of all this, all right? The context that matters. Remember, the data only measures the portion of the economy that is functional. If that economy is shrinking, then you're not really making headway. It's not as great as it sounds, especially, and I want to point this out, especially because millennials are bigger than boomers, and they're in their 30s. So our labor force participation should be exploding. It's not. It's not. You can't use, well, the baby boomers are retiring, therefore it's shrinking. Nope. Millennials are bigger. And millennials in that prime age labor force in the 30s, right? Making babies, buying cars, houses, furniture, baby stuff. And they should be spending their asses off, right? Accumulating more private debt. It's not happening. Let's look at the next one. Employment ratio. Again, 59. I rather that it was up here. And then you can tell me it's 4.2% unemployment versus here. Then I'll be excited. I'll be like, wow, this is great. Right? But again, context is what matters. Context is what matters. How about inflation? Okay. We are hitting, and this is not just the US, this is globally. We are hitting dangerous levels of inflation worldwide. Okay. And of course, it all starts with the US. Uh, don't give me the story of transitory. We'll get to that later. Supply chain, blah blah blah. It's not that. Forget about that. Those are symptoms, not the cause. The cause is not raising rates, not tapering, flooding liquidity, worthless digits of dollars and euros and yens and whatever into the market, thereby causing inflation. The cart doesn't pull the horse, all right? It's due to liquidity, monetary inflation. So we are hitting dangerous levels. Now, what does that mean? Well, if you go back in history, you're going to see that when inflation hits dangerous levels, right up here, when it hits dangerous levels, it causes food to income to rise. Food becomes very expensive, and you end up with an Arab Spring. Okay, you end up with social unrest, and we are skyrocketing towards those levels. And remember, it has to sustain. It can't just be like a pop and drop. It's got to kind of sustain itself up there. So we're hitting those dangerous levels. That's not good. Okay, that's not good at all. Now, in the context of all this, smaller labor force participation, woohoo, unemployment claims are so low, unemployment is so low, everything is wonderful. Look how great this is, and don't make this political. This has nothing to do with politics. They're all the same shit as far as I'm concerned. I don't care about politics. In the context of all this liquidity and smaller economy, corporate profits are soaring. They're exploding. So don't tell me supply chain. Uh, this is quarterly, okay, and this is after tax profit. So you see that we hit a low of 1.6, okay, and then it exploded. This is quarterly, and it exploded to $2.7 trillion per quarter. We were all locked down. Government was passing out dollars like candy, and corporations are making historic profits, 2.7 trillion per quarter. Where do you think that money came from? Mars, Vietnam, Sri Lanka, Lebanon? Where did this money come from? Of course, the government. So we have a deficit problem. We have a monetary policy problem behind the power curve, and everybody's telling you how great things are, and why isn't everybody so happy? Weekly claims came in at the lowest level since 1969, the lowest ever population adjusted. This is wonderful. It's not wonderful. It's not. Taking a look at the taking a look at the real disposable personal income. Real means inflation adjusted, and what you see is it's right back to its normal trend. Okay, there was a big bump, free money for all, but the trend is, right. So if we have such shortages of labor and there's so many jobs open, why aren't wages exploding higher? Why are wages not catching up to productivity? Which I don't have the chart to show you, but they're way below productivity. And that has to do with also automation. So why aren't they exploding? Right? Labor shortage. Everybody's competing for workers, but wages are not. What about uh, U.S. family income? Okay, again, uh, adjusted for inflation. We had the big bump with all the free candy for everybody right in here, and then kaboom, collapsed. Well, look at the trend, Nick. It's going up. Well, yeah, but not relative to productivity. It's really lagging. Okay, and this is falling. And again, if everything is so wonderful, and 4.2% unemployment, woo! Corporate profits historic high, woo! Everything is wonderful. Why aren't wages rising? Now, I caution you that if they do start to rise, guess what? You're going to have more inflation. Labor unit costs are going to go through the roof. Zombie companies are going to start to suffer and they're going to start to blow up. And, the big bump from all the free money for all was really nice here, okay, in the previous chart as well. Okay, it was all nice, beautiful. Hey, this is great. We're all rich. Right? It's all nice. But now we're on the other side of the hill. We're going down. So you're going to raise interest rates as we're going into a slowing economy? Mm, yeah, that should work well. All right, let's continue here. Fed's fund rate. Like I said, we've spent decades lowering rates rather than raising them. Okay. And again, once this pops, it's all great. It's all great when you're seeing uh, interest rates fall. The problem is when they start to rise. That's the part that goes snap, and then everything gets ugly. Um, this is the best way to measure the effectiveness of stimulus printing for the people's economy. Uh, for every dollar that is created, there should be at least $1 of GDP. Okay, that would give us a nice flat. Here's a dollar. Here's a growth in the economy by a dollar. That would make sense. Ideally, you want it to be like it was in the past, where you create $1 and you get more than $1 worth of GDP growth. Okay, that's wonderful. That's the way it should work. Since 1980, it's been the opposite. The more we print, the less economic growth we get. The more we print, the less economic growth we get. The more we print, the less economic growth we get. That's not good. You print $1 and you get 16 cents of GDP growth when you used to get more than $1. There's something fundamentally wrong with the economy. Now, everybody likes to say, don't look at the GDP to debt, look debt to GDP. It doesn't tell me anything. I want to know how much economic growth we are getting with each new dollar. And it's falling and falling and falling and falling. We're headed in the wrong direction. Okay. Um, so keep that in mind. Now, federal funds rate. Now, I posted this chart, and you can see it. I have it somewhere. Uh, anyway, I'll find it later. I don't have enough time, but it's there. And I said, look, inflation adjusted, the Fed's fund rate is negative. It's negative 6.2. I'm sorry, 6.14. And I said, look, the first target is going to be down here, and my second target is down here. And now we've far surpassed that. Historic levels. Far there's I don't even have a target 3. But again, nobody's going to tell you that, hey, Fed's fund rate inflation adjusted is negative 6.14. These are dangerous levels that we're at. These are very dangerous. So, keep this in mind that when you hear these nice clickbaits and these feel good, oh my God, it's 4.2%, and weekly unemployment claims are historic lows, and this is great, this is wonderful. Think of the context, okay? Think of the context. Think of what the Fed says. It's price stability and maximum employment. Okay, well, maximum employment is relative, right? So you're not raising interest rates, so you don't have price stability. And maximum employment relative to the labor force participation is not that good. So you can do price stability, you can do maximum employment. What can you do? Why are you there? But you're printing and you're QEing and you're not tapering. Same thing with deficits. Oh, we'll just print more. Well, the more you print, the less labor force participation that you're getting. Right? It's falling. It's the same thing as I was showing you in the chart. You're getting less and less economic growth. Right? Look, it's not in my head. It's in the data. Right? Why is this falling? Why is labor force participation falling with more and more money printing? Okay, why is this happening? It's crazy. It's crazy. Okay, these charts don't lie, and then you're getting these inflation dangerous areas where social unrest follows. You got corporate profits soaring, and they're telling you how great things are when real disposable income is not really rising. Okay, household income is falling. It's not even productive adjusted. This is inflation adjusted. So anyway, I wanted to make this video. It irks me. I just wanted to make you aware of it. Do what you will with this information. Thank you very much. I'll talk to you guys soon, and have a great rest of the day. Take care. Bye bye.